At some point over the last few years, investing stopped feeling like analysis and started feeling like watching a game of Wheel of Fortune. Honestly, it's been pretty entertaining. It is hard not to smile when someone on Reddit turns a weekly options trade into a 2,000% gain and then immediately posts a screenshot like they have just unlocked capitalism's speed run. While it may be awesome to watch from the sidelines, it is also deeply unsettling. For most of modern financial history, markets were not perfect, but they were at least anchored to something real. They relied on things like earnings, cash flows, and economic data, the boring adult stuff. Historically, markets have always had periods where they go through manic phases. Whether it was large-cap stocks in the 70s, internet stocks in the early 2000s, or even the banks in 2008, eventually, fundamentals showed up like gravity. You could ignore them for a while, mock them, and even post memes about them, but sooner or later, intrinsic valuations mattered again. There was always an unspoken belief that value investing was at the foundation of markets. Over the last few years, it feels like that belief is changing. It's not because prices are high. Markets have been expensive before. It's not because speculation is present either. Speculation is basically a market tradition. What feels different this time around is that the relationship between market prices and fundamentals feels loose. It's like they're technically in the same room, but they just aren't on speaking terms anymore. Since 2020, if someone tries to bring fundamentals back into the conversation, they get the same reaction as someone asking the DJ to play Nickelback. The pandemic was not just a shock to the markets, it rewired them. The story used to be to invest for the long term and buy quality companies at fair prices. Since the pandemic, the story has changed to buy the dip because stocks only go up. That phrase alone should make you a little uncomfortable, not because it hasn't been working, but because it has been. What used to be a strategy has quietly just turned into an assumption. This mindset shift did not come out of nowhere. It was the perfect storm of a mass influx of new investors, interest rates being historically low, and the money printer doing its best impression of a fire hose. Slowly but surely, the markets adopted a new mindset where every dip is a gift and every sell-off is a buying opportunity. Here's the part nobody likes to talk about. This did not just affect retail investors, it affected professionals too. When markets stop behaving the way you were trained to understand them, experience stops being an advantage and starts becoming a liability. Take Michael Burry, for example, the same person who famously profited $800 million from his bet against the housing market in 2008 and inspired the movie The Big Short. He's the human embodiment of trusting the fundamentals and ignoring the noise. Recently, he shut down his hedge fund because his estimation of value in securities was no longer in sync with the markets. The market has stopped pricing assets based on fundamentals, and you can see it across the board, from gold to real estate to equities to crypto. If the market can stay irrational longer than you can stay solvent, then value investing stops being a viable strategy. If someone who built their entire fortune on trusting fundamentals is wondering whether gravity still applies to markets, it forces a deeper question. If fundamentals aren't driving prices anymore, then what is? This is where behavioral finance enters the story. While traditional finance assumes markets are efficient and rational, behavioral finance assumes markets are human. It assumes that things like human psychology, emotions, and psychological biases drive market behaviors. For most of modern financial history, this was an unpopular concept, but after 2020, something changed. The question shifted from what is this company's intrinsic value to how will people react to this news? When narratives matter more than balance sheets, momentum overpowers valuations. Behavioral finance stopped being used just to explain edge cases and started being used as the operating system everything else runs on. Human behaviors like greed, fear, herd mentality, and recency bias have always affected markets, but they used to be constrained. Information moved slowly, participation was limited, and trading had friction. Now, you can wake up, see a hot stock tip online, and deploy capital before you've even finished brushing your teeth. Narratives don't spread over months anymore, they spread over hours. Social media and the internet have collapsed the distance between information and reaction. When enough people agree on the same story, prices move with little to no regard for fundamentals. Institutions have been forced to adapt as well. Instead of just modeling traditional inputs like cash flows and discount rates, they're now incorporating online narratives and sentiment analysis. These variables have done a better job explaining short to medium-term price action than traditional metrics. Is this just a fad or a structural shift in markets? There's a good argument for both sides. History tends to tell us this is still just a phase and that gravity will eventually show up, meaning we're just living through a good old-fashioned bubble. But the other possibility is hard to ignore. The disappearance of friction, the rise of social media, and the mass influx of new investors may have structurally changed the markets into a new regime, one where markets don't just price cash flows, they price attention. The real question is whether this strangeness is temporary or whether we're seeing an investment landscape that is fundamentally changed.